Right now, the global economy looks stable. Markets are open, banks are functioning, governments say everything is under control. And that's exactly why this is dangerous. Because in 2026, the system isn't crashing loudly, it's quietly breaking underneath. For decades, the global economy was built on one powerful idea: growth. Countries borrowed money, businesses expanded, people spent more than they earned, because tomorrow was always expected to be bigger than today. Cheap money made it possible. After the 2008 crisis, central banks flooded the system with liquidity. Interest rates dropped close to zero. Money became easy. Debt became normal. Governments borrowed trillions. Corporations took massive loans to expand. Even households entered the cycle. Homes, cars, lifestyles, all financed by future income. And for a while, it worked. Stock markets exploded. Tech companies reached trillion-dollar valuations. Global trade connected every corner of the world. It looked like unstoppable progress. But beneath that growth, something fragile was forming. Because the entire system had one hidden dependency: low interest rates. And then, inflation arrived. Not slowly, not gently, it surged. Supply chains broke. Energy prices spiked. Pandemic aftershocks collided with geopolitical tensions. Suddenly, everything became expensive. Central banks had no choice. They started raising interest rates aggressively. This is where the real shift begins. Because when interest rates rise, money becomes expensive. And when money becomes expensive, debt turns into a burden. Now think about this. The world isn't just using debt, it is dependent on it. Governments need it to run budgets. Companies need it to operate. Consumers need it to survive rising costs. So when borrowing becomes costly, pressure builds everywhere at once. Businesses slow hiring, startups lose funding, real estate weakens, and quietly, layoffs begin. Not in one place, across multiple sectors, across multiple countries. But here's what most people don't see. This isn't just about high interest rates, it's about timing. Because all that cheap debt from the past decade is now coming due. Trillions of dollars in loans are reaching maturity, and they need to be refinanced. But now, at much higher rates. Which means companies that once survived on easy money are suddenly facing impossible costs. Some cut expenses, some sell assets, some simply collapse. This is not a single crash, it's a slow squeeze. And while this is happening, another pressure is building. Governments are running massive deficits. To support economies, they spent heavily: stimulus, subsidies, social programs. Now they need to borrow even more, but at higher interest rates, which means a growing portion of government budgets is going into just paying interest. Not development, not growth, just survival. And when governments are forced into that position, they start making difficult choices. Higher taxes, reduce spending, currency adjustments. Each decision creates ripple effects. Now add one more layer. Global trade is no longer as smooth as it once was. Countries are becoming protective. Supply chains are shifting. Efficiency is being replaced by security, which sounds safe, but it's more expensive. And that cost flows into everything: products, services, daily life. So now the system is under pressure from every direction. Expensive money, heavy debt, slowing growth, rising costs, and yet no single moment of collapse. Because this isn't a sudden failure, it's a controlled strain, like a structure carrying too much weight, but not breaking all at once. Instead, small cracks begin to appear. A bank here, a company there, a currency slipping quietly. Individually, they don't look alarming, but together, they tell a different story. The system is adjusting, not by growing stronger, but by becoming more fragile. And here's the most uncomfortable truth: there is no easy fix. Lowering interest rates again risks inflation. Keeping them high risks deeper slowdown. Every option carries a cost, which means the world is now navigating a narrow path with very little margin for error. So when you look at the global economy in 2026, you won't see chaos. You'll see normalcy, markets opening, news staying calm, numbers appearing stable. But underneath that surface, the foundation is shifting. And the real question isn't, when will it collapse? It's, how long can a system survive when it depends on conditions that no longer exist?